I'm Tom Boley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Wednesday, May 8th, 2024 edition of Trading Places live at earningsbeats.com. I'm Tom Boley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next maybe 25, 30 minutes or so. I'll try to get this done, wrapped up before we go into the market open. I've been doing a little bit better job of that lately, so try and keep that going. As far as some of the news, really no economic news out this morning. We've still got some earnings coming in, more of the second and third tier types of companies reporting. Disney, one of the top market cap companies, did report yesterday. That was not a very good report. They did come up a little bit short of expectations on the revenue side, and as a result, market didn't really treat them very well. We saw stock drop down probably close to 10% or so, maybe 9%. I don't know where exactly it finished, but not a very good day there. But we got another day today, and it's going to start off with interest rates, that at least those 10-year Treasury yields on the move back to the upside. And with that, talked about a lot of inverse correlation between that and the stock market, and in particular, the IWM, which tracks the Russell 2000. And right on cue with the yields moving back to the upside, we have futures down this morning. So let me give you those numbers real quick before we get going. Right now, the diamonds, which track the Dow Jones Industrial Average, down about 0.16%, a little less than 0.2%. The spiders down about 1/3 of 1%. The QQQ down a little more than 0.5%. And the IWM, which tracks the Russell 2000, down 0.9%, almost a full percentage point. We saw a little bit of selling right into the close yesterday on the IWM in particular, but really across our major indices. And that momentum to the downside seems to be picking up a little bit of steam this morning. So now that we've made the move back up and taken out some key levels, now it's going to be up to the bulls to see if they can defend, particularly the moving averages that were just cleared. If we don't, and we go back down below the moving averages, then it's starting to look less like an uptrend and more like sideways consolidation. Maybe some sort of a bullish wedge forming. Normally, a bullish wedge is going to put in a slightly lower low than the first low. But we'll talk about all that. In fact, let me go ahead and jump into what happened yesterday. So pull this up just a little bit. There we go. We got the Dow Jones Industrial Average finishing up 32 points, S&P 500 up 7, NASDAQ down 2, mid caps up 5.8, almost 6 points, and the IWM up about a half a buck. So on a percentage basis, everything was pretty close to the flat line. The Dow up 0.08%, S&P up 13/100, the NASDAQ literally down 1/100. So you can see not much. Mid caps did gain 0.2%, and the IWM gained a little bit more than 0.2%. Transports rising a little more than 1/3%, but it was still not exactly the type of candle and the kind of comfort that I wanted from the IWM. You can see that even though we've been going up, a lot of it's been gaps and then really no follow through during the day. Off of the low, I mean, you can see we finished on the low about a week ago, literally after being up intraday, came back down, closed almost right on the low. More than 1/2 of the next day's gains was actually the opening gap. And in the last 3 days, those candles aren't really exactly inspiring for the bulls. And, we're going up against resistance. Look at the AD line on the transports. I mean, this really kind of sums it up. Even though we've moved higher the last 4 days, the AD line's gone down to new lows. Now, I talked a little bit about this last night because, I get so caught up in a lot of the short-term stuff here on the show because I'm a momentum trader. I look mostly at the short term, but periodically I do like to kind of take or use some perspective, kind of back away from the charts, maybe look at longer term charts. And when you look at the transportation index, first of all, a couple of takeaways. This is not a group that normally leads the market to the upside. Usually it just kind of performs with the S&P 500. So it's not one of the leaders that we necessarily need to see tremendous relative strength from in order to feel great about the market. But we also don't want to see a downtrending when the overall market's moving up. So I take a little bit of bearishness away from this, but I'm not going to make a major call in the market based on the transportation index alone. One puzzle piece, that's all it is. But it is a weak puzzle piece, that's for sure. Looking at some of the other indices, the AD lines have come back up. You can see the Dow, we've made up our way back up, maybe halfway back, maybe a little bit more than that of what we had given up during the first couple weeks of April. And the AD lines kind of come back, and I don't know, maybe it's about halfway back. It's hard to tell. There's no numbers on here. So it's just tracking. It's just a cumulative tracker. The numbers really aren't that important. S&P 500, after dropping, again, through the third week in April, we've come back, probably gained a little bit more than half. And I don't know, it looks like still we probably gained maybe half of the AD line back. My point is that with all of these, you can see the AD lines coming back. And with the transports, even though we bounced back, we're not seeing it. So I'm still not seeing any real comfort from that group in terms of accumulation, a lot of buyers. So I think we just need to be, somewhat cautious in that regard, or at least with respect to transports. Moving on to the sectors yesterday, saw some leadership that we had seen mostly back in March and in early April with materials. You can see the last 2 or 3, maybe 4 weeks after we reached that high, you can see we had pulled back quite a bit on the materials, but now turning back up again, starting to look a little bit more like the right side of a cup. So I was a little bit, more bearish on the materials group, but you got to adjust as the numbers change. And this is starting to look, I thought maybe we'd fail at the moving averages and maybe head back down to that 87.5 level. Instead, materials turning up, looks like we're trying to put in the right side of a cup, which pretty bullish as long as we remain above these moving averages. Utilities, this is a group that really hasn't stopped going down. We had a little pullback in mid-April, but other than that, this has been a group that's been moving up pretty steadily since February. So utilities being a defensive group. Now, keep in mind, you might say, oh my gosh, that's horrible. Utilities are outperforming. If we take a look at the utilities group and we compare it to the S&P 500, and we, let's go out 5 years. We'll look at a weekly chart. This is where having a little bit of perspective and kind of zooming out away from the chart and taking a look at a bigger picture kind of looks a little different, doesn't it? With what utilities are doing. I mean, no question, since February, we're going up. But look at how much utilities had underperformed. I mean, they're allowed to go up sometimes, aren't they? Aren't they allowed to beat the S&P 500 at some point for a period of time? I mean, look at the beginning of 2022 when the market was weak. That's when we had the cyclical bear market. We saw a lot of strength in utilities on a relative basis. And since February, we've seen money really rotate mostly away from growth. So it kind of makes sense that this is the time that we would see some relative strength in utilities, and that's what we've seen. I would have thought maybe utilities might have topped around the 66 level, but they've continued to go. And at this point, let's see, where were we? 69 and change. So this is where we had topped at 66 here, came over and put in highs, I guess, 67. So maybe 66, 67. That's where we hesitated. And then here in the last week, a lot of it, by the way, has been gap ups. You can see not a whole lot of last 4 days. Yesterday, we got a little bit of candle body, showed a little bit of buying intraday, but otherwise, the last 3 days mostly were just gap ups. Intraday selling, we came back up, kind of closed near the high, or closed near the opens, I should say. So not a lot in terms of candle bodies. But we did see some more buying accumulation yesterday. But this is one of the groups right now that, certainly trending higher. Can't argue with what's going on the chart. So until we see some kind of definitive top or maybe a pullback where we come back down, lose the 20-day moving average, something like that, until we see that, utilities remains one of the better areas of the market. You don't hear me say that very often. Let's go back one more. Here we go. So discretionary 180 seemed to be a problem. We fell back below the 50-day moving average yesterday. I know Tesla fell a little bit. We'll talk about autos in just a second. First, though, broadcasting and entertainment took a big hit, went back down, closed below recent lows. A lot of that was Walt Disney. Disney, again, down about 9-10% yesterday. It was by far the worst performing stock on the Dow Jones, and it was the second worst performing stock on the S&P 500. I believe BLDR was the worst performer. I think that's Builder Source. But anyway, BLDR, I think, lost about 17 or 18%. Second on the list on the S&P 500 yesterday was Disney. So that's your culprit when you look at the broadcasting and entertainment group. There's autos. You can see moving back down again. Of course, Tesla took it on the chin yesterday, and as a result, we saw the auto group giving back some of its recent gains. We'll see if we can hold. We got gap support coming in just a little bit below 650. Both moving averages. This is going to be a critical level, I think, on this pullback for autos. Can we hold these moving averages and start to turn back up? If we do, we're likely to get a golden cross where that 20-day moving average moves back up above the 50-day moving average. And if you look, we have not seen this cross back above since we lost the 50-day moving average back in the middle part of January. So it's been a long time, been almost 4 months since we've seen the 20-day above the 50-day. And that's what we're heading for if the group can hold on to support and start to turn back up. If it doesn't, then probably we're just going to get this little kiss right here and then back down the 20-day goes. So I think we've got a pretty big test coming up on the auto group and on Tesla here over the next few days. Airlines on fire, breaking out for the past week or so until yesterday. Yesterday, we went down a little bit, had an inside day. We'll see what happens from there. I don't know. Maybe we get that reversal coming off of that. But to the downside, I would watch recent lows. We've had two of them just a little bit above 160. And you can see that 50-day moving average now has crept up above 160 as well. It's at 160.84. So you got maybe about 5-6% downside action possible in the airlines. But I would not want to go back down below the two recent lows and that 50-day moving average. And when we look at AD lines, I mean, just about everything we look at here, AD lines struggling. Look at the airlines. Airlines are showing some strength. So again, talk about utilities leading, airlines leading. It's kind of been a weird market of late, but that's where the strength is. Moving on, 10-year Treasury yield. So I pointed out this opposite effect that the 10-year Treasury yield has had for months now on the major indices, the U.S. Stock indices, particularly the IWM, small cap. And we had been rolling lower and lower on the 10-year Treasury yield after topping above 470. I thought we would go back down into this 430 to 440 area. Got the 50-day coming up right at the top of that. And you can just see between 430 and 440, we've had a lot of noise here over the last few months, a lot of difficult resistance levels to get through. Then when we pulled back, we held 430. So that 430, 435, maybe even up to 440 area, that would be kind of a level I'm looking at for yield support. And yesterday we got to 442. So we got close to it. And now today it looks like we are bouncing. Couple of things technically on this chart. Do we get back through that 20-day moving average? That will be a big test, because if you're thinking that, hey, this downtrend in the 10-year Treasury yield has begun, well, you should fail at the 20-day. Technically, that's one of the areas in a downtrend where you want to look for failure. Failure at the 20 and then a new low. That would begin to suggest perhaps that a downtrend is underway, a more significant downtrend. Obviously, we already had a short-term downtrend. But, you get those all the time, even in uptrends. You'll get a short-term downtrend, then you go back up to a new high. But that more intermediate term uptrend really it starts to bring into question whether or not that's in play any longer if you fail at the 20 and then set a new low. So that's why I'm always 20-day moving average is one of the things I really like on my chart. As long as I'm trending up above a rising 20-day EMA, I'm going to feel pretty good. And when I'm trending below a declining 20-day, which this one is, we got the 20-day rolling over. It's now declining. Go back up. If you fail and go down and set a new low, that starts to give you more of a feel of a more extended downtrend. So we'll see how it all plays out. We do have a big economic report coming out. I believe it's next Wednesday with the CPI. That will be the April CPI number. I believe the April number from last year was still fairly elevated. I want to say it was still like 0.4 or something like that, maybe in the 0.3s, which means it's a pretty good number to go up against in order to bring down the annual rate. But after April, I want to say starting in May, the May number, which will be out in the middle part of June, those numbers started coming down a little bit. So we're going to lose those numbers and they're going to be replaced by the new numbers, which means that annual rate could start to tick higher if inflation doesn't come back down below where it's been the past couple of months. So that could spook the market a little bit down the road. I mean, we could be, maybe, still sideways consolidating or still trying to break out. Anyway, that's going to be something that we're going to watch certainly on the 10-year Treasury yield and the impact that's going to have on stocks. Remember, next Wednesday. S&P 500. I've been looking at the chart and I'm thinking maybe cup. I'm thinking, I don't know, maybe inverse head and shoulders. Let me just show you a couple of these patterns. Actually, let's add some room to the right side over here. We'll just put 35 days over here. All right, so how could this possibly evolve? Well, I mean, there's a lot of ways that it could evolve. I mean, bearishly, we could just simply sell off and see that VIX spike again. I don't believe that is the most likely, but I mean, certainly that's one thing we could do. Again, I don't really believe that's going to be the case. I see a couple of things here. Number one, I would say I'm kind of got a little OCD. I always like to use, like when I'm doing any kind of patterns, I almost always use the color black. I don't know why, but whenever I'm doing a pattern, I like to do black. So here was the high. I mean, is this, whoops, I don't want to draw that. Oh my gosh, that would be ugly. Let's put that there. Let's put that here. And I mean, are we going to come, right back over here somewhere and kind of finish out this cup, and then maybe a handle later into May. And then once we get to the end of May, historically, we line up for more bullish action. So maybe from there, we could maybe come back and put in a little bit of handle, through about the 25th. I mean, that's kind of when this period, this kind of bearish or more cautious period that we're in right now historically, maybe we finish the cup and, then we have a handle. That's one possibility. And when we're going up, I do like to look for bullish continuation patterns. But that's not the only one that could develop. Let's get rid of this. Let's see. We have a top here. I mean, we could have something like, I don't know which high I want to use. Maybe it's this high right here. So maybe that would be like a neckline. We topped, we came down, we put in a little bit of a left shoulder here, right about maybe a left shoulder right in here. So maybe we come up a little bit further, maybe come over here and put in maybe some sort of a right shoulder, on a pullback. Just nothing significant, just a little minor pullback that could be today's move to the downside with futures down, who knows? And then a breakout above that. So then what you would be looking for is after you put in a right shoulder, symmetrical would be back down, looks like just below 5150. But I don't know. I mean, you could go back down to the 20-day. That's 5100. Anyway, after you pull back here, maybe from here, you would be looking at something like that, which would then break back out above the neckline. That's a possibility. And it could last a little bit longer. Maybe we have futures down, but maybe we rally back and go back up one more time, hit this neckline, maybe even put in a false breakout and then come down, put the right shoulder in, and then have a big rally. And it could last a little bit longer. Maybe it goes to the end of the month. But that would be another pattern to maybe look for. Maybe less bullish, still bullish continuation, but less bullish than those two patterns would maybe just be some sort of sideways consolidation for a period of time. I mean, there's your resistance. We've kind of established now a support level. Maybe we sit in this range for a little while. I mean, moving up and then going sideways for a while, normally it's going to resolve to the upside. So one of the tests, I mean, if we go back down below these moving averages, that is absolutely a possibility because it's telling us it's a trendless market. I mean, we've already gone above the 20 once, back down below. Now we've gone above the 20 and the 50. And if the futures this morning lead us down, short term back down into the 5,000, 5,100 level, we're going to go right back down below the moving averages again. That really is starting to reek of sideways consolidation, no trend, a trendless market, which again is still bullish after an uptrend. Sideways consolidation, normally you break out of that in the direction of the prior trend, which in this case is higher. So that's a possibility. So sometimes when you ask, okay, what's the market going to do today? And I just kind of shrug my shoulders. This is why. I mean, until you get that breakout, until you really have a breakout and you're back into all-time highs and starting, what looks at that point would look like a much more significant uptrend in play, these sideways consolidations, these periods of selling followed by buying, really just consolidation. It's really hard to tell which way it's going to go. I've already pointed out 3-4 different patterns that could develop. I'll give you another one. And this one would be the scariest one, with the market potentially still going higher. And that would be if we worked our way down somewhere down like into here, where maybe we go a little bit lower than the prior low. Breakdown, that's going to have the bulls out, the bears out in full force. Then you'd really be, wondering what's going on. But what I would say here is that the overriding pattern for me would be something like, you'd have this trend line there, and then maybe this trend line here. And what you would see is maybe just a little bit of a squeezing, almost like a pie effect. Maybe it just goes down and kind of equals that high or something, something like that, where you just get like what's called a bullish wedge. So that comes off of an uptrend, and a wedge, think of it kind of like a piece of pie, almost squeezing a little bit. So the slope of the line connecting the highs is a little bit more down than the slope connecting the lows. And they're just kind of working toward each other. And then eventually we get the market and, turn back up. And that right there would be a bullish wedge and a breakout to the upside. So that's a possibility. That would be the more scary or the scarier variety for sure. All right, let's keep moving because I want to try and be done by 9:30ish. NASDAQ, really same kind of pattern, back up above the moving averages. Can we hold? Don't know. We're going to find out. IWM, same thing, but with a 10-year treasury yield reversing back to the upside today and breaking the short-term downtrend. Do we keep moving up in that 10-year treasury yield? If so, got a little bit of a reversing candle yesterday on the Russell 2000. We did fill this gap. It looks like we got almost all the way back up where we had gapped down and had that selling from back in the middle part of April. Well, we've kind of filled that gap now. Maybe we are going to roll back over. I don't know, short term. But like the others, it could just turn out to be, off of this uptrend. This is just more of a cup. Could be inverse head and shoulder. Could be all the patterns I just talked about with the S&P 500. So, kind of watch it. This is why, if folks ask me, am I in the triple leverage ETF? And I want to talk about that just a couple minutes, but no, I'm not in the TNA. Haven't been in that one for a little while. I am still in the IWM, the QQQ, the spider. I'm treating those as long as I feel we're in a secular bull market, I'm hanging on to those. There's so much rotation going on in the market. I still think, we're continuing to get whipsawed. Thought we were really making a move to the upside in the IWM when we went through 210 back at the end of March. Nope, not ready yet. Interest rate cuts got pushed back, and as a result, You can see some renewed selling in the group. Now it's coming back up. Got the Fed talking a little bit more dovishly last week. Be careful. I mean, we're still not out of the woods here. Leverage is not really not something I would consider doing right now, especially if you are much more conservative. You should be, if you're conservative or even, less, you have lower risk tolerance, maybe you still take on risk, but maybe you're just not, Vegas casino type of a gambler. And in that case, you can still pick up the TNA once in a while, but you want to try and get it at a major support level, because if you're wrong, you want to get out quickly. You don't want to hold these and watch them go up and down like yo-yos, especially the downside, because you're going down 3 times as fast. And that's not a very fun trip. Transports, I mentioned earlier, not exactly a fan of what's going on here. Not really seeing any positive signs other than the fact, we did rise 4 days in a row, but it's just the nature of that move to the upside, not exactly inspiring. Chart of the day. So if you're unfamiliar with earnings beats, if maybe this is the first time you've listened to us here, welcome. Certainly appreciate you stopping by. Hopefully you'll return. Listen to us. I think we have a different perspective about the market than most. I have no problems being bearish, but the stock market is bullish a lot more than it's bearish. So you got to beat me over the head to get me bearish, but eventually I will turn bearish if the market says to be bearish. I think overall, most people should just remain on the long side. If you don't follow the market, it really you'd be doing yourself a big disservice to stay out of the market. I think folks are taking on much bigger risk being out of the market than being in it over time. That's what history tells us. But anyway, at Earnings Beats, we're more momentum traders. So if you want the chart of the day, you can come down here, scroll down. There's a place where you can sign up, name, email address. This is a chart and 2 paragraphs. It's really simple read. Comes out 3 times a week, Monday, Wednesday, Friday. We just had one this morning. I'll go over the chart here in 1 second. But it also gets you an invitation to any of the free webinars that we do. We reach out to our Earnings Beats Digest community, and we're talking about tens of thousands that have signed up for our Earnings Beats Digest. This is a big newsletter. We certainly appreciate our entire community, especially our paid members. We wouldn't be here doing this if it weren't for our paid members. And if you want to join, today would be a good day. We got the live trading room coming in. I'm going to talk more about my earnings strategy of some intraday trades, getting in, trying to get a few bucks, make some money, and get right back out. That's all about what today's live trading room is going to be about. So if you want to join, you can click this button. You will need to sign up for a 30-day trial, but it's free. It won't cost you a thing. In fact, with the next 5 live trading rooms, because we do them every Wednesday. So today would be a great day to sign up there. So what is today's chart of the day? For me, it's AppLovin. APP, big move up, nice little cup. My question is this, and this is the question I posed. Is this bullish pattern more important than the group that AppLovin is in, which is really struggling right now, and that's software? I guess it depends on, how you organize, your different signals by importance. To me, price volume is number one. So if we get a cup, we get a pullback, maybe down to that 20-day moving average, I think this is a tradable stock. The fact that it is a leader in software makes me like it even more. The fact that the software group as a whole is not doing well kind of takes a little bit away from it. But I like these patterns. I'm a pattern trader. I do like the trade patterns, and I see a cup here. A little bit of a pullback. If the market's weak, why not get a leader when it comes back and tests the 20-day moving average? That's the way I look at it. And if it morphs into more sideways consolidation and goes below the 20, move to the sideline. Take a small loss, move back to the sideline. If it works, and let's say software starts to regain its strength and this remains a leader, this cup, 78, 79 down to 65, this measures up to about 93. So if you get it on a 20-day test at 72 and the measurement, it ultimately breaks out, you're talking about making 20, 21 bucks on the stock versus maybe $1 to the downside. could be pretty impressive. So yeah, I still pay a little bit more attention. I give maybe a little bit more credence to the fact that this is a leading stock, and it's still a good group. Software has been weak for a little bit, taking a break, but during secular bull market advances, this is a group you really want to be considering. All right, so as far as the leveraged ETF goes, and I know it's 9:30, just give me a couple minutes here. Here's the IWM, and I just threw up a couple of numbers here. I went back 21 days, which is basically a month, 126 days, which is roughly 6 months, and look to see, okay, what did the IWM do? And I'm going to make that just a little bit bigger there so you can see it. You can see down 0.29% over the last month or so, and up 18% over the last 6 months. If you go to the TNA and we do that same exercise, you can see we're down about 3% in a month, which is a little bit more than the 3%. But we're not close to 3% up on the upside. The IWM is 18. 3 times that would be 54%. This is only 44%. So not exactly perfect there. And this one I didn't quite have time to finish before the show started, but I can do this really quick. Rate of change there, rate of change right there. We're going to do 21 and 126 and height 1, and that should do it. And so here on the TZA, which is triple bear on the IWM, you can see this went up more. I think it went more than 3 times over the last month. Let me see. What was that? Yeah, it went down 0.28. The TZA actually did really well. But here it went up. And actually, TZA did better. Well, better in a sense. I mean, down 42% in 6 months. I wouldn't be bragging about that. But it wasn't down 3 times. 3 times 18 would have been down 54%. But one thing I will say is when you take a look at the IWM, and if I get rid of this, let's just say I'm going to pull up the price action here of the TNA and the price action of the TZA. You can kind of look sometimes and see that the numbers just don't really line up. For instance, on this low here on the IWM, I'm not going to look at numbers, but we didn't get as low as here. We're probably $5 or $6 higher on the IWM than we were at this low. The TNA, though, which clearly should be up, is actually down. So do you see how over time you get a little bit of erosion in these ETFs? This is why personally for me, I don't hold them. I mean, if you get excited about holding the TZA because it only goes down 44% instead of or 42% instead of 54%, I mean, feel free, but I don't want to lose 42% on anything. But it's just, when you go into a period of a lot of ups and downs, a lot of volatility, that's where you start to lose ground on these leveraged or juiced ETFs. They'll still work, and they work great in an uptrend. I mean, if you can catch an uptrend, the TNA is probably going to work out more than triple the underlying index, in this case, the IWM or the Russell 2000. But it's this constant. I mean, look where we went down, back up, back down, back up, back down, back up. We got all the way back up to where we were before. See that? Look at the TNA. It did not get up to where it was before. So even just over the course of that month, a little over a month, you can see the deterioration. But again, when you go through periods of strength, that TNA is going to do well. Same thing here. We get down to this low, which is almost down to this low, but the TZA is down below quite a bit, below that prior high. Anyway, just be careful. Do some research on these leveraged ETFs. I do think that they work, but they don't work as well as you might think, especially if you hold them. They are designed to track at a 3-to-1 clip over the very short term. It's actually designed to do it for one day. But if you get into an uptrend, the compounding will actually give you sometimes more than the 3% over that period of time. So just want to point it out because I get questions on the IWM and the TNA, not so much the TZA, but the triple long, I get questions on all the time. Am I in? Am I not in? When would I get in? And I just want to point out, number one, those of you, some people say, well, he likes the IWM. I'm just going to get in the TNA and just sit in it. Well, when you go through periods like we're going in, you're going to see erosion. So they're not going to perform over the long term the way you might think they're going to. Just keep that in mind. Anyway, let's go back, get a quick update on the market. I know I did go 5 minutes in, so not great, but we can see market down a little bit today. Dow pretty much flat, but otherwise the other indices down. Got the VIX up 1.5% back to 1343. No major, no major move there. I'll certainly be keeping an eye on it if the selling begins to accelerate. But so far, the VIX, I still think at a low rate, and that's good overall for the stock market. One stock we talked about last night, I'll surely be talking about in the trading room today, ANET. Last night it was over 290. We talked about it in our Don't Go Away in May session that we had. And I said, we, by this morning, we could be back up at, we could be up near the high at 305 that we saw back in March, or we could be all the way back down and gap, 270 or maybe even, below, and showing a loss. Well, we went from 292 or 3 after hours last night. We opened today at 283 and immediately dropped back down almost to gap support. And look at how this looks. And many times when these stocks have earnings news, they have these huge moves in the first 10, 15, 20 minutes. And so if you see a stock that's gapping up and you think, oh, well, if it gaps up, market makers are on the other side, which they are. Sometimes you'll get that quick push to the downside and you can get filled quickly at much lower levels. In other words, opens up at 283. You could go in and say, well, gap support's 274. If it gets to 277 or 278, I'm going to, maybe get in a little piece of my shares. It would have worked perfectly today. You'd have gotten in and the stock would be right back up. But anyway, we're going to talk more about this strategy of how to play these opening gaps in about 20 minutes or so. So take a break. Members, I'll see you in about 23 minutes. Those of you who are not members, go over to Earnings Beats right now, sign up, go into this link on our website, join, and come in for this Trading Places Live trading room. Last week, I did 2 trades in the room, both made money. Not a lot of money, but they both made money. And so if you start getting better and better at this, spotting the stocks that work, this is something that, can give you a little bit of extra income from time to time. But like everything else, they don't work 100% of the time. You got to go in realizing that, which is why when you get started, maybe doing paper trades or very, very small trades make a lot of sense. Anyhow, that's it for me. I appreciate everybody tuning in. Thanks so much. Be back here in about 20 minutes for the live trading room, and then be here tomorrow for the Trading Places Live at 9 a.m. Have a great day, everybody. Happy trading.